Welcome to the Juice Consumer Direct Podcast. I'm Nate Clegg here with Carson Poppenger and Jake Thorpe. And today we're going to be talking about how to adjust to market conditions. And guys, market conditions are kind of crazy right now as we're recording this podcast. So let's talk about that. Like what's happening? How do you adjust to it? What do you think?
Yeah, so we've seen this high rate market that we're in now going back 2.5 years. I think we've been through a number of these cycles at Squeeze since I began back in 2009. We were in sort of like the beginning of we were in the right in the middle of the Great Recession, I guess is what they called it at that time. And that's when we began operations, and we've been doing mortgage since 2012. And in that time, we've seen many ups and downs of the rate market. I think there was a cycle in 2015-16, and then the rates have just been really low through COVID, and abnormally low for an extended amount of time. And everyone kind of in the mortgage space that we work with was fully expecting rates have to go up in order for them to go down again. It's just sort of necessary. You can't just have a low rate market like that indefinitely and continue to generate business, right? And so the rates we sort of at the end of that low rate market, beginning of 2022, January, February. And in fact, myself personally, like I was sort of like, I'd seen all my friends get low rates. Like they're like, oh yeah, I got 2.9, 2.7. I'm like, I'm still at like a 4.5. And I was like, I had not yet gotten that. I'm like, I've got to get this done before the rates go back up.
And they had to go back up, right?
And they're heading that way. And so January 2022, I was able to lock in my rate and was like, whew, I got it in before the end. And then March of 22, they started to creep up, and they've been there for the last 2.5 years. And it's been sort of an extended amount of time. But I think the more we've been in this, the more we hear, well, are they really that high of rates? I mean, because in 2000, I had a 7.5%, 8% rate. We're kind of back there again. But in the year 2000, with the first home that I bought. And, but here we are, we're sort of trying to see if inflation can be calmed down. The jobs report was not great. They came out in
really
July.
Bad, yeah.
And, all indicators and people that are watching the markets and everything say they waited too long. The Fed should have cut the rate in the last meeting. And, the next rate drop may not be until they meet again in September.
Yeah, and on a personal level, I always kind of feel frustrated because interest rates are the only way to hedge against inflation that we have in our economy today, right? Well, there was way too much money out there from COVID and from the low rates, and that causes inflation, and inflation kind of got out of control as well when transportation costs went up with gas going up and some other factors as well. It just feels like it would be nice if there was something else besides just the bully club of increased interest rates, which really affects the consumer more than anybody else, because basically what businesses do is they just increase their rates too to the consumer, the end consumer at the end.
Prices go up.
Yeah, everything goes up. And yeah, I think they did wait too long, like you said, to adjust the interest rates. But that sort of thing affects our industry a lot. Like you said, obviously there's a direct impact on mortgages. Mortgages slow down if interest rates are high. There's less of a need to do like a traditional mortgage. I mean, there could still be some refinancing and things that happens, but interest rates really affect things quite a bit just beyond just mortgages.
So it's been 2.5 years. I was just going to add that it's been 2.5 years, and the mortgage companies that we work with that are doing the large consumer direct operations, they've cut their teams way down. They've trimmed operations to kind of where they need to be for this volume of business. Companies that were doing 2,000, 3,000 loans a month with their consumer direct groups are doing hundreds of loans a month. And so they just didn't need those huge staffs. So they're not quite back to the point where they have the volume to staff back up. And so we're sort of in this kind of weird period where they're thinking, okay, rates are going to start to come down again.
Yeah, they're prepping for it.
But we're not quite staffed for it yet.
They're kind of hoping for it too. They're like, we think we're anticipating that this is going to happen at some point. It's like they want to be ready for when it happens, but they don't want to have the cost associated with being totally ready.
Well, there's going to be a lot of people, and there's going to be a little bit of a race. So if our clients or potential clients If they're smart about it, they're going to spend a little bit of money right now, because the last 2.5 years, people have had a new purchase mortgage rate or even a refinance mortgage rate if they needed cash out and they're struggling, that they're going to refinance really quickly here. And so there's going to be a race to that subset of people who've had their mortgage done over the last 2.5 years that need to get it done now to have a better payment. So if they're prepared ahead of time, if they're prepared right now, or they're preparing right now to go after those refinance opportunities, that's the smart thing to do right now, for sure. At least that's my opinion on it.
Yeah, I think that 2 years ago, end of 2022, we sat down as an executive team and we anticipated a lot.
2021.
2021, yeah. And we anticipated a lot of these things happening. I've mentioned this before, but at that time, was it 75 to 80% of our business probably was mortgage? Is that?
Yeah, that's what you said.
And we recognized that our company's health was so tied to the mortgage market that it was kind of dangerous, especially given how unsustainable those rates were. We all recognized it, and we made it a real objective to diversify and to get involved in other verticals. And whenever these things happen, there's always opportunity, right? Constraint brings creativity. Constraint brings, being scrappy and figuring things out. And I mean, Carson started Squeeze in 2009. You saw an opportunity in a really unique economic time. And we were able to pivot and scramble and figure it out. Similarly, COVID hit. I remember Rudy Gobert got COVID. It was like Friday the 13th.
Yeah, I remember that.
And we're all kind of
mad at him for
freaking out. All the toilet paper's gone. We're like, what does this mean for our business? What does this mean for our lives? Is this the new normal? And Carson scrambled. We scrambled, and in one day we turned our whole team to work remote. And we had never worked remote before that. I mean, maybe a few agents, but it was really not something that we did. And ultimately, pivoting that quickly allowed us to scale in a way that we had never been able to before. Now we have agents that work remote on a consistent basis, and we didn't have the systems in place to enable and manage agents that were remote. Yeah. And within a week, we figured it out. And ultimately, that was what enabled us to scale from what we probably had 150, 200 agents at that time to 500 plus agents.
Yeah.
And it's those constraints that breed creativity and opportunity. And it's not always easy. You don't get out of these economic cycles without a little bit of pain. But trying to understand where those opportunities lie and where you can, make money and find margin and profit is super important.
I think we talked a lot about being able to be nimble and pivot quickly on just different business changes and market conditions. And, as we've talked in this podcast in the last couple episodes, even I'm thinking about different examples that we've talked about that, even just recently where, you mentioned COVID, and when that happened on that date, we were like, we've got to be fully remote on Monday. It was like, at that time we were 250 people or something like that. I think now we're over 400, but 250 people that were all working in the office on Friday, all had to be working in their home on Monday without any technical problems and, with all the different software and all that kind of stuff. But we issued computers to people that couldn't get in and access the network and the tools that we had and everything. And, our IT team did a fantastic job, and we were up and running. We had a record day on Monday.
That was cool.
Yeah,
we weren't sure how it was going to go, and we had the best day we'd ever had on that Monday.
Yeah, I was in the office. Nobody else was. There were a few of us.
I think I was there, and I remember you were just like, you were so pumped because it was like
the leaderboard was
what happens when we come together. Yeah,
the leaderboard was rocking, and there wasn't anybody in their desks.
We were all waiting, like this isn't going to work, right?
Yeah.
Well, that moment, the COVID moment, and the interest rates created all kinds of really interesting trends as a result of it. And I think what we're experiencing right now is going to create some interesting trends. So like COVID created, there's a lot of debt that was created during that period of time. And there's also the mortgage rates went up to address some of that inflation. And we saw some things that were really interesting. I didn't anticipate, for example, that certain home services would really thrive and certain home services would decline. So solar, for example, is heavily dependent on lending based off of the solar panel and the interest rates that are connected to it. And if the interest rates are too high, all of a sudden the payment that you're paying on your solar panels is significantly higher and it can't offset the savings that you would normally get. So solar has really struggled in recent times. At the same time, remodeling has really thrived because people stopped trying to move out of their house and upgrade your home because all of a sudden interest rates are too high to upgrade your home. So all of a sudden they're like, oh, I'll just remodel. So remodel companies started doing really amazingly well during that same period of time. And what trends do you guys think might come out of this? Probably some interest rates bumping down. They did bump down a little. They're probably going to bump down again just because the economy's kind of having this tough moment. What trends do you guys anticipate coming out of this little, bubble that we just burst?
Well, I think in the short term, there's always a little bit of recency bias with consumer sentiment. So, we have a partner that we work with now, and we do some significant volume with them. And over the weekend, their volume 3x, 4x, because people saw that interest rates were down from 7 to 6.1.
Yeah,
and I gotta lock in because I think it felt like we got to a point maybe a few months ago where people were maybe adjusting to the new normal a little bit.
Yeah, I think
there started to be some momentum, and then all of a sudden, people want what they can get right now.
Yeah.
The problem is not everybody is equipped to handle that sort of volume. Also, coming out of COVID with interest rates in the 2s and the 3s, a lot of our partners didn't have loan officers or salespeople that actually knew how to close deals because they'd just been taking orders.
They were layups, right?
Yeah, how hard is it to close a 2.5 interest rate?
Right.
It's like, this is clearly going to benefit you.
I think that you have to take that in mind too with your sales strategy with your team now, as you're getting this surge of inbound activity and things that don't lose opportunities because you're just order taking, and you get accustomed to taking that call and just sending it out. You don't have to do any kind of salesmanship or close them, make sure that they're, sold. So when you get a lower quality inquiry or lead, and you just, tell them, well, call me back when you're ready to refi, and then you miss out. Yeah. You miss out on a sales opportunity there. And so I think staying sharp is important, and just making sure that you follow, make sure your processes are all buttoned up, because, there's nothing for me, the times that whenever in the past 15 years, we've found some kind of significant problem, for instance, we're like in our sales process and our scripting and our, some process that we have where we find an issue and we fix it. I'm like, that's awesome. I'm glad we fixed that. But how much could that have made us if we would have fixed that 6 months ago?
Right.
Or a year ago, and always be looking for those things that you need to fix now, and don't wait until it becomes like, oh, we have to fix this. Had you fixed it earlier, it would have, saved you a lot, made you a lot, whatever.
And I think you're right, especially with the mortgage companies. Right now, you're in a position that they may or may not realize it. I think most of them realize it, though. You need to have your staff prepared for kind of this middle ground where you're still going to need to work your leads. The interest rates aren't that good, but they are better. And you need to have the staff in place today for what the volume you're about to see as things really start to pick up. And that includes, working with us or working with people within your own internal team to get more mortgage officers up there and make them better.
Yeah, and you don't know how long this lower rate market's going to last. And so do you want to go out and staff up a huge team and do all the hiring and everything like that just to deal with a wave where, you can rely on a team like ours, don't hire 200 people. Squeeze has, hundreds of people available. And, we definitely are available for that. We get calls all the time. We got one a couple weeks ago. Oh, there's a hurricane in this area. Can you dial for us today? It's like, yeah, probably we can, and make it happen and take advantage of those opportunities. But it's better to sort of not have those interruptions,
One of the clients
scramble.
Yeah, one of the clients that we've talked about before, Jacob, they've been really smart during this whole period of time. It's a mortgage company, and for privacy, we won't say who it is, but they were able to adapt to the market conditions really well because they shifted from just straight up mortgage to home equity lines of credit or home equity loans, and they've done really, really well with them. And that's partly because if you're in a position where your debt's increasing, which is very common these days, if the job report came out and it's not great, there's a lot of people who are either underemployed or unemployed. As a result, their debt's increasing. A home equity line of credit, even if that interest rate is higher, is still going to be better than a credit card interest rate. So a lot of people are paying off their debts with their home equity line of credit or their home equity loan. I anticipate that's actually going to escalate. And the other good thing about it is that, and I'm not a tax expert, but my understanding is that's typically a tax deductible interest rate versus a credit card, which is not. I anticipate that happening a lot right now, where interest rates still aren't low enough for somebody like, we probably all locked in our interest rates at 3% or less, right? We're not going to refinance our entire mortgage, but we might do a home equity line of credit. Do you think that's the case? Do you see that happening?
Yeah, and there's still value in a lot of cash outs too, because the interest rates on those credit cards and personal loans and some of these like unsecured debts are so much higher than even the interest rates on mortgage right now. That's true. And so there's still like meat on that bone. I think to touch on what Carson said, you just want to make sure that your team doesn't overreact to these trends, because you don't know how long this is going to last. Yeah. You want to maintain some semblance of flexibility, and that should always be a strategy that you, or something that you think about when you're creating your strategy. How do I maintain redundancy? How do I maintain flexibility and not go all in on something that may or may not be permanent? You have to maintain that flexibility to adjust to these trends quickly. Contractors are a great way to do that. Internally we'll cross-train our agents so that they can work on multiple projects, so that if these things do happen,
we can step in.
We can step in and try to fill that gap for our partners. Yeah,
and sometimes you got to look at technology, and you look at resources, and you look at partners to help scale in these opportunities. And we're perfect for that. And because if you're trying to scale what is typically kind of an opening conversation for a mortgage or any other lead generation that you might be doing, to scale that internally yourself during what may be a pocket, that can create some serious internal brain damage as you just put so much work on that. And it's going to distract from probably the better opportunity, which is I'm going to get my team ready, my internal team ready, so that they're in a position to close business and generate revenue versus opening it up.
We talked about consumer debt being part of the verticals that we work in. That's another vertical that we've really expanded since the mortgage rates started to go up. We had a lot of partners already in that space, and so it continued to scale. Consumer debt is over $1 trillion, and unfortunately, it doesn't seem like that's going to be changing. Even if the rates come down, consumer debt's going to continue to be a thing. We live in this day and age of, influencers and everything. We used to be sold stuff when we went to the store. Now we're being sold stuff all day long in our feeds and consumer products and spending. It's just this, hey, you got to go on that trip, buy that thing. It's constantly in our face. And so consumers, have to get more disciplined, obviously, and be more cautious about the consumer debt they're generating, but it doesn't seem like that's going to be changing. And so, making sure that, the companies that we work with, we're helping consumers resolve their debt issues, get out of those debt situations, manage their payments, get their credit under control and their debt load so that it can be more manageable, and that they can, improve their credit score and get some breathing room. They feel like they're under all this constant pressure to make these payments and things like that. And, we work with companies in that space to help them with, customer acquisition for consumer debt. So
yeah, it's a tough time, right? I think with all this consumer debt, you mentioned earlier when you bought your first house, you had a 7% interest rate, but the problem is the wage growth hasn't matched the value of everything else, right? So
home prices are
through
4 or 5 times that.
Yeah, I'm sure. And it's a tough time to be like a first-time home buyer, to be someone that's just graduating. Like, what's a starter home now?
Yeah, it's not what it used to be.
There's a lot of financial pressure on everybody, and it's nice to be involved with companies and with partners who take that into account and really do have a desire to help people and to put them in better financial situations, because it is so stressful. A lot of people our debt partners, for instance, they may be talking to someone on like their worst day.
Yeah, worst day ever.
They're like, I've got nowhere else to go. How do I figure this out?
Yeah, and that's why I'm so grateful that we have a team here that trains and prepares our agents for those situations, and that we have the agents that we have. They are high caliber, they're talented, so that when they do talk to somebody on their worst day ever, they're actually prepared to have that conversation and have it in a mature way, in a way that that consumer can trust that conversation, and it increases the propensity to buy. We've seen that over and over again with our partners who are participating in this, that when we send a consumer over to them to finish that conversation, they're more likely to buy coming through our process because they had that good conversation going into it.
Right. And all of our marketing strategies, our strategies and our messaging needs to match the needs of the consumers. We have to be able to put ourselves in the shoes of the consumer. What are they feeling? What's stressing them? What are the pain points that they have? And the messaging needs to revolve around that, whether it's scripting or ads or, video production. All of that needs to aim towards a solid customer experience that will give them a higher propensity to transact at the end of that. I feel like sometimes companies aren't as responsive or reactive to those feelings and those trends as maybe they need to be.
It's an emotional part of the sale for sure,
Absolutely.
and it's a sensitive one too, like Nate hit on. And it's one of our messages internally to our team is a big part of our messaging to our team is that we work with companies and products and services that are actually helping people. They're, improving someone's quality of life. They're helping them save money on their mortgage. We're helping them get out from that debt load or that IRS tax issue that they have. Helping them with, home security system for their house, making them safer.
Aging in place is a huge one. We've done a lot
Green
of work with walk-in tubs where instead of going to a care facility, they're able to stay in the comfort of their home because now they're able to be safe in their home.
And that's a real thing. And there's some studies out there that say that the longer you can stay in your home comfortably, the longer you'll live and the better your quality of life. So those are absolute things that are positively impacting the people we work with. So it's awesome.
Yeah.
Well, some kind of final thoughts I think that I would like to share on this is, one, you've got to be nimble. We are absolutely at an inflection point in our economy. Our clients and potential clients, they should absolutely be looking at the trends and anticipating them because things are going to change over the next 6 months. I think working with us makes a lot of sense. For the reasons that you said, Jacob, that we don't know how long this is going to last, right? But we're in a position to be flexible where a lot of our clients are not flexible. And it's time to sit down and talk together and figure out what's next.
Yeah, and I would just say, ensure that everything you're doing, understand the burden that the consumer is feeling, that your customer base is feeling. Understand that, put yourself in their shoes. Make sure that everything you do is with that in mind, because that is how you will build a customer base that's loyal, that retains, and that ultimately will be profitable for you because you can continue to establish that customer base and establish a strong relationship with them.
Yeah, I think just in closing, my final thoughts that, this rate market that we've been in, I think the light's at the end of the tunnel and we can see ahead that, interest rates coming down is going to bring a lot of relief to the consumers, hopefully help with all the added expenses that we've had over the last 2 years as we've dealt with all this inflation and everything. And, we need those prices to come down to help spur the economy, or the interest rates to come down to help spur the economy so that, we get, better jobs reports and economic growth that we need. And, that obviously Wall Street needs as well. So looking forward to that.
Well put. You've been watching the Juice Consumer Direct podcast. I'm Nate Clegg. I'm here with Carson Poppenger and Jake Thorpe.
Like and subscribe.
Any comments, leave them below and we'll try to get to them.
Thanks.